Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. We've talked a lot in the last few days about the great rotation, the shift out of bank stocks and into the miners off the back of China's economic stimulus. But what does it actually mean for those investing in the banks? What's the outlook for the sector, considering interest rates will be heading down again some point in the future, and competition in the home lending market appears to be heating up again? Remember, this is general information only, and you should seek professional advice before making investment decisions. Nathan Zaia is Morningstar's bank analyst. Nathan, welcome back to Fear and Greed.
Thanks for having me.
What did you make of the rotation last week, really? A great rotation might be overstating it just a little bit, but the rotation out of bank stocks to miners. Is that what happened, do you think?
Well, it's interesting. Is that what caused the divergence in share price performance between them in the first place? I think there's been a lot of different factors. And look, we don't sit here and try to work out for investors, which sector might be hot in the next, short while, and we might want to rotate. We're valuing businesses on the fundamentals. But, I would say if you look at our price to fair value for the major banks, like on average, we thought they were around 20 to 25% overvalued. In CBA's case, it's been over 40% overvalued. And if you look at the big miners like BHP and Rio, roughly 15% overvalued now. So, they're relative. We did see more value in the miners versus the banks. So I guess it makes sense for a bit of a rotation, but I'd point investors to other sectors outside of banks and miners. I don't think it should always be, a one or the other. There's names in industrials, in healthcare, in consumer cyclical that we think are much better value. So, some of it, the share price of banks has sold off as the miners have gone up. So probably is some of that happening, but the past 12 months, bank shares have been on a tear and really surprised everyone. So not surprised that some heat's coming out of their share prices.
Okay, so let's just think about what the outlook is for bank shareholders. If you've held them for a while, for the past couple of years, you're probably pretty happy because you've had plenty of capital appreciation. The Commonwealth Bank, you said 40% overpriced on valuation. Where does that go from here, do you think?
That's a difficult one to answer, and I think one that probably got wrong, over the last few years. But we've got some pretty optimistic forecasts that underpin that valuation in terms of loan growth being better than it has been in recent years. We see margins improving a little bit from where they are, loan losses staying pretty low over time, efficiency gains. So we put all that in the mix, and we still tend to think it's expensive. So for that sort of price to be justified, I think even more needs to go right. And it probably isn't really trading on the fundamentals at the moment. There probably is just, money piling into whether it be the index or the sector as a whole. So we can speculate on why it's so expensive, but all we can do is try to value it. And we think over time it's likely to converge if our forecasts are correct.
Okay, what about the other three? NAB, Westpac and ANZ, that's in order of size. They're still overvalued, are you saying? They're not as much as the Commonwealth Bank?
Yeah, exactly. So NAB and Westpac around 15% overvalued. ANZ, not so much. I think there's been some uncertainty around potential penalties and some cultural and governance issues, which I think is probably weighing on the share price. And even the integration of Suncorp Bank probably has some investors nervous and preferring the other banks over ANZ for that reason.
Is there a big difference between the banks? Because you can make an argument, just buy an Aussie bank and it's sort of rising tide floats all boats, and whatever the opposite of that also happens. So, is there a lot of difference between them?
They're obviously exposed to the Australian economy, but NAB and ANZ have a bit more of a business tilt as opposed to CBA and Westpac, and on the funding side as well. So you see a lot more of the household deposits in CBA and Westpac. So there are differences, but like you said, they're still very exposed to each of those sectors or trends anyway. But there are some small differences. CBA, a lot higher returning bank, so It does mean they generate a lot more organic capital, so that does deserve a premium. So yeah, that there are some differences, but yeah, definitely competing with each other across the board.
Stay with me, Nathan. We'll be back in a minute. My guest today is Nathan Zaia, Senior Equity Analyst at Morningstar. Competition. We got some figures out of APRA this week, and it suggests that in terms of market share, Commonwealth Bank is competing more aggressively, and I'm talking about mortgage market here. Same with Macquarie. Looks like National Australia Bank has gone backwards in terms of market share, which the inference in all this is that they're competing more, we're getting more cashbacks, that sort of thing. What's it mean for earnings for the banks when, particularly in the Commonwealth Bank, it's the biggest mortgage lender in the country, when it starts getting more aggressive? Because it wasn't last year, it's come back this year. What's it mean for earnings?
Yeah, I think it depends what is happening on the funding side that's, I guess, pushing them or encouraging them to be a little bit more aggressive as well. And I think there probably is a little bit of headroom to be a little bit more generous on lending rates. We've seen a little bit of heat come out of the deposit market, and some of that is pricing in lower cash rates. They've repaid the TFF as well, so there's a little bit less of a need to hold that extra liquidity. So, yeah, I think part of that is being passed on to borrowers in terms of, and like you said, the competition to win a new borrower or refinancing. So it kind of tells you that the banks are happy with the sort of returns that they can get on home loans at the moment. And I think there was a lot of talk around them not, justifying or making a return above their cost of capital for a little while. So I think that the outlook does look a little bit better. And look, you mentioned CBA. I wouldn't rule out NAB and Westpac either, like in the near term. I think all the majors are pretty much in a position now where they're managing margin, but they don't want to lose share and not materially. So, yeah, I'd expect that competition to sort of continue over the next 12 months. And Westpac reiterated its ambition to grow at least in line with the market. They've made a lot of process improvement, consistency in their lending processes as well, which they think is going to help win over brokers. And I guess most banks point to improving NPS score, so it can be hard to pinpoint which is the right one. But yeah, I think a lot of the trends in terms of time to approval and consistency, it looks like all the majors are competitive again. So yeah, I think it's going to be an interesting market. I don't think that you can expect much in the way of margin expansion given the competitive environment.
What about when interest rates start falling, and they will eventually start falling, be it late this year or into next year? Is that good for bank earnings, bad for bank earnings? Where's that sit in the competitive spectrum?
Yeah, well, their funding costs won't be as falling as much as their lending rates because they have some very low savings accounts and transaction accounts, which they don't pay much on. So all else equal, lower rates would be negative for bank margins. But the intensity of competition is what really matters. I think that's the key variable. And, banks aim to manage both lending and deposit rates to try and get a margin where they're making an adequate return. So like we've seen in the last little while, rates flew up and the banks didn't capture all the margin upside you would have expected. So I think the same will happen on the way down. So yeah, I'd expect, some margin pressure, but not for it to be material. And probably won't happen with the first cash rate cut, but over time, there's room for the banks not to pass on everything to borrowers, be a little less generous on term deposits and savings accounts as well. And I think in a lower rate environment, probably is less motivation or incentive for those savers to be making sure that they're getting the best savings rate that they can and making sure they qualify for those bonus rates. So there'll probably be a little bit of an easing on the funding side of things as well. But yeah, all up it's a negative, but the banks generally manage both sides of the balance sheet.
You, Nathan, you said all else being equal before you started that particular comment, and it's very true with banks. All else being equal, and they never really are totally equal, particularly when competition comes into it. What about outside the majors, the Bank of Queensland's, the Bendigo and Adelaide's, those regionals? They've had a tough time of it. Their funding costs have been more expensive. And for a number of years now, we have seen Bank of Queensland in particular struggle share price-wise. Bendigo and Adelaide, the long-term CEO, has stepped down. What's the prospect for some of these regionals?
Yeah, Bendigo actually does have a pretty favourable funding mix. They do have a lot of deposits and within that transaction accounts and some savings, which can be lower than the term deposit rate. Bank of Queensland is the one that does have that greater reliance on the term deposits. So if we do get into an environment which I expect where the pressure or the intensity on deposit rates eases, then Box stands to benefit quite materially from that, because that is a big part of its funding. So I think the outlook is probably better for Box than it has been in recent times. But they've had operational issues and governance issues that they're working through as well. So they need to make sure they execute on that and hopefully capture some upside from lower funding costs as well.
So it's going to be fun being a bank analyst for the next 6 months, Nathan? Or it's always fun?
It always is.
But there'll be a bit going on, I suppose, is my question.
Yeah, definitely. When rates are moving, there's always different strategies and pricing action from the banks. And it'll be interesting to see how each react.
Nathan, thank you for talking to Fear and Greed.
Pleasure. Thanks for having me.
That was Nathan Zaia, Senior Equity Analyst and Bank Analyst at Morningstar. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.